Welcome back, everyone. For those who know me, you know on my channel this year I'm doing a brokerage account challenge where I am actively trading, and I know that a significant portion of my viewership are passive buy and hold long-term index fund investors. So I've received numerous comments saying, Jake, what are the tax implications? Are you not worried about the tax consequences of actively trading? So in this video, we're going to talk about that, and whether you're a day trader or a swing trader, I'll explain exactly what your tax obligations are if you choose to be an active trader. First thing you should know is there is no tax consequences in non-taxable accounts. This is your Roth IRA, traditional IRA, 401k, HSA, 403b, 457, or the government TSP. Year to year, you are not paying taxes on what you earn in this account, so if you're day trading, swing trading, whatever, it doesn't matter. However, if you have a taxable brokerage account in which you must report your activity on your yearly taxes, then this is important. You do need to know what the tax implications are. And up front, there are three kinds of taxes: paying no taxes, the marginal tax rate, and then long-term capital gains. And paying no taxes is when you buy and hold. You only pay taxes if you sell for a capital gain that year. Warren Buffett likes to say his favorite holding period is forever, because if you never sell, then you never have to pay any taxes. Your marginal tax rate is what you pay if you sell a security in less than 1 year. And to get long-term favorable capital gains, you must buy and hold and then sell later than a 1-year holding period. And since we're just reviewing all this, let's go ahead and cover the three kinds of investments. There's interest, dividends, and capital gains. And interest is what you get in a checking or savings account, government bonds, ETFs, CDs, treasury notes. And for interest earned, you always pay your marginal tax rate. Now, I'm not going to go into detail about marginal tax rates. You can find another video to cover that. But basically, there are these tax brackets, the marginal tax brackets. And if you have $100,000 worth of taxable income, so this is after your deductions, then you're paying 10% on the money between 0 and $9,875. You're paying 12% on the difference between these two, 22% on the difference between these two, 24% on the difference between these two. So your federal taxes owed on $100,000 worth of taxable income is $18,079, or about 18%. That is your effective federal tax rate on your taxable income. So just because you make $100,000 doesn't mean you're paying 24% on all that money. The next kind of investment is dividends paid out by a company, and dividends can either be non-qualified or qualified. If you want to pause the video and read the exact definition of what a qualified dividend is, you can go ahead and do so. But basically just hold the stock for 2 months, longer than 2 months, and then your dividends should be qualified. And that's nice because for qualified dividends, you'll pay long-term capital gains. For non-qualified dividends, you're going to be paying short-term or your marginal tax rate. And long-term capital gains is what everyone wants to pay because for most people, this is the cheapest rate. So how this works is there are only three brackets: 0%, 15%, and 20%. Now, if your taxable income for the year is between $0 and $40,000, if you're single, you pay 0%. If it's between, once again, this is your taxable income, between $0 and $80,000, once again, 0%. However, if you're between $40,000 and $441,000, you're paying 15%. Same thing for married. So most people are paying long-term capital gains of 15%. The third kind of investment is capital gains itself, and this can be stocks, options, mutual funds, real estate, and how it's treated for tax purposes. Once again, short-term, held 1 year or less; long-term, held 1 year and a day more. And something you need to know about investments is that capital losses offset capital gains. So if you're an active trader jumping in and out of stocks, you don't know what your tax bill or tax obligation will be until you end the year. You could have taken a huge profit in January, and that might be offset by a huge loss in December. So you won't know what your net amount of capital gains is until the year finishes, and then you can calculate it. So for my brokerage account challenge where I am actively trading, it's me versus the index fund. Let's go ahead and calculate the tax obligation of the index fund if you were to buy and hold long term. If you were to invest $25,000 and then wait years for it to double in size, grow to be $50,000, your cost basis was $25,000. So you made $25,000 in capital gains, appreciation, or sales. So you held it longer than a year, and let's go ahead and say your taxable income is $100,000. You fall in this 15% tax rate bracket. So if you sold for a $25,000 profit, 15% of that is $3,750. But let's now do me. Let's now do a day trader, swing trader, active trader, anybody who holds a security for less than 1 year. Well, if I swing trade, day trade, and I start, once again, my cost basis, I start with $25,000. I then, at the end of the year, well, in less than a year, I double up my money and get to $50,000. So for my taxable year, January 1st to December 31st, I increase the size of my account by a net positive amount of $25,000. We now have to check my marginal tax bracket to see what my tax obligation will be on my capital gains. And I've already told you that my income will probably be close to $100,000. As long as it's above $85,000, yes, I'm in the 24% marginal tax bracket on any additional income past $85,000. So let's go ahead and change this and say, once again, we're choosing nice round numbers here. But let's say that I owe, I have $125,000 worth of taxable income. So we just add $25,000 into that 24% marginal tax bracket, and I would owe, well, this individual would owe $24,079, or their effective rate on their taxable income would be 19.2%. So if I am successful this year in my brokerage account challenge and I make $25,000 in profit, 24% of $25,000 is $6,000. And when you compare the two, $6,000 versus $3,750, the difference is $2,250. However, there's a variable here that we're not accounting for, and that variable is very important because it is time. How long does it take long-term passive investors getting the favorable tax rate to double their money? So if you're earning 9% in an S&P 500 index fund, at that rate money doubles every 8 years. So it'll take you 8 years to get to that $50,000 mark. And if I can do that in a single year, if I can double up my money by actively trading, then paying this extra $2,250 is way more financially advantageous for me. Of course, in my brokerage account challenge, I'm not making any promises to you. I'm learning this as I go. I definitely might fail to do so this year. If I fail to outperform the index fund, then yes, the commenters who left comments are correct. I was being tax inefficient. I would have been better off just buying and holding a simple low-cost index fund. But beyond that, talking about the tax consequences for day traders or swing traders, in my opinion, it's not really a big deal. Worst case scenario, you pay your normal marginal tax rate. Your marginal tax rate is what you pay for any W-2 job. If you're driving Lyft or working an office job or you're a teacher, then you could argue you're being tax inefficient by paying your marginal tax rate. It's what everybody normally pays. So if you can successfully be an active trader and earn more than a passive buy and hold index fund investor, then, I mean, honestly, being a day trader is more tax efficient than having a day job, because if you earn W-2 income, you have to pay FICA taxes, you have to pay Social Security and Medicare, and potentially state taxes, depends on the state. So I just think it's really interesting for people who do try to make day trading or swing trading their full-time profession. Yes, you're not as tax efficient as the buy and hold long-term investors, but it's still really not that big of a difference. Okay guys, if you enjoyed this video, give me a thumbs up so the algorithm knows it's good. In addition, consider subscribing to my channel if you haven't already. I will include the playlist for my brokerage account challenge down below if you want to watch the videos in order. If you have any comments or questions, let me know. I love hearing from you guys. And until the next video, take care.